All right. Well, we will get going here. So grateful to everybody that's attending. If you're joining a little bit later, watching this recording, um, happy to have you join us on the next one, which is going to be next month. But for today's purposes, I'm Evan Polaski. I'm Director of Capital Raising here at BlackGate Partners, and really wanted to start this web series as this is or webinar series as this is the first one we're doing to hit a lot on what we're seeing at BlackGate in the market, why we execute the business plan that we do, and why we feel that it's one of the best business plans available for investors to help mitigate their risk and see consistent both income and appreciation out of their investment base, and therefore should fit in their investment portfolio. So today we're going to be talking about why necessity-based retail is resilient in any economy. You all might understand a little bit of the background of this topic as to the purposes of it and why we think that we should, in these uncertain times, why we should be concerned about, the future here. But with these necessity-based deals or necessity-based tenants, we see this both in good economies and bad. Okay. So what we're really talking about with necessity-based tenants are those everyday visits, those consistent foot traffic type uses. So that doesn't just include grocery stores, but it also includes those medical service providers, urgent care, dental providers, orthodontists, et cetera, banking, and especially in market downturns that we've seen in the past, value-oriented type retailers, the things that you're going to need every day, regardless of whether the economy is up or down. And we love these tenants, ultimately, as we're managing retail portfolio, we want the tenants that are going to be paying rent for the long term, and then we share that rent with our investors. So therefore, as an investor, it's really helping you derive value in your investment when these tenants continue to pay rent, both in the good economies and bad. So at a high level, we're really seeing strong consumer spending. I know some of us are starting to feel that pinch with additional tariffs and just general unrest in the market that we've been seeing over the last couple of years in reality. But even during economic slowdowns, consumer spending away from home has remained strong. As you can see, based on the U.S. Census data, it continues to grow year over year, all the way back to 2015 even. And if you look further back, even further. But again, these are both discretionary spending and necessity-based spending. But as the market starts to erode and there's less confidence in the market, you continue to see the spending on those needs for those day-to-day needs. Everybody needs to eat. You need to stay safe and healthy with your medical providers. And there are still some value or kind of what I would consider discretionary, your quick service restaurants that continue to perform in softer economies because you get a bit of that step down effect where people might have been going to a sit down restaurant that spends a little bit more, costs a little bit more. But in today's market, they're going to Chipotle instead of to that nicer restaurant. But the biggest thing is over the long term, we continue to see consumers spend money because they need to survive. So breaking down some of the types of tenants that we really focus on within our portfolio, the biggest one, or not the biggest one, but a key one is the quick service restaurant. As noted, in affluent times, people are more apt to spend at higher end restaurants when you feel more flush with cash, you're not in a savings mode. But even those that can't afford those higher end restaurants, it still is that step up from maybe dining out. I can speak to my own family's experiences. We love to cook in, but there are definitely those nights that we want to get out and just not cook. So where are we seeing those trends? We're seeing a lot of them in coffee shops. So obviously your Starbucks, but also the local coffee shops are seeing strong foot traffic growth, 8%, over 8% year over year, that really fit into that morning routine, that kind of that small you know, treat yourself kind of moment where you can go out and only spend a few dollars, but to feel, um, to give yourself that experience versus really staying inside. Another big concept that has been growing over the years has been the chicken concepts. So we see a lot of Nashville hot or the hot chicken restaurants. Obviously, Chick-fil-A is a household name that has been growing like crazy over the years. Um, and then each location tends to have, or each area tends to have their own chicken restaurants as well. But that is another one that is seeing pretty strong um, growth, both in same store sales year over year, and therefore that tends to translate into expansion opportunities as they are looking around. And then the final one that again most of us know, the Mexican restaurants, your Chipotle's, your Qdobas in our area in Southwest and Central Ohio. Curito is another one, but the burrito places that you step in, you you order at the counter and you get a pretty quality meal. And what we're seeing overall with consumer spending, again, good economies and bad, is people still want that quality that they're getting uh, without having to pay the full price of a sit-down restaurant. So I remember years ago watching a documentary on the founding of Chipotle and how he is the founder is a classically trained chef who really opened the first Chipotle in order to fund a full service restaurant, but that concept clearly took off. And so you are seeing those high quality ingredients in store made guacamole, for instance, that give you a lot of that high quality without the full price tag of the full sit down restaurant. Another concept that we're seeing, or a trend back to these quick serve restaurants, is it's not all roses, but they do tend to perform well year over year. So McDonald's in particular tends to be the ubiquitous fast food, which I would classify as a slight uh, optically a slight step down from, say, your Chipotle's or your quick serve restaurants, but they've been continuing to grow massively. And that tends to be an indicator of, hey, we're getting into more uncertain times in the economy, and therefore their store sales are growing as people continue to try to find ways to cut. So even though other tenants that we have in our portfolio, like Chipotle and Starbucks, are seeing some softening, it's not universal, and it's relatively muted when you compare to the higher end restaurants. So Chipotle has seen some softening sales in same store sales, but that is also counterbalanced with more growth. So a certain amount of that is going to be cannibalization from inside their own portfolio. And then Starbucks, who is, front page news as to some restructuring that they're working on doing, but they are trying to get themselves back onto sure footing. They still have they still clearly have very strong performing restaurants. Um, but as a whole, the chain is seeing a slight softening and indicative of a softening economy where people are looking for a cheaper option, as well as some of the internal issues they're having where people are trading out to the local restaurant versus the chain restaurant. But ultimately, as noted in the last slide, coffee shops are still growing and seeing more foot traffic year over year, even with a slight softening in the sales. Then we get into the ubiquitous, we're in a recession. We saw this a lot in the financial crisis, but the dollar stores. Um, Obviously, they tend to be popping up on every corner. If you're driving around in any suburbs, you start to see more Dollar Generals and Dollar Trees, and that is telling of the time. They do fulfill a need in our economy to have some of that, very inexpensive necessity-based retail. And it is a property or a tenant base that has good credit and is continuing to grow. Where I've seen a big shift with these is in good times, they tend to focus more on rural markets. And then as economies or recessions start to hit, just some general contraction that we're kind of living through now, they start to move into more dense areas as well to capture that type of demographic. But ultimately, you know, like I said, these stores serve a need in any economic cycle, as there are always people who are looking for, uh, you know, inexpensive needs. Then we get into an area where we're seeing kind of a lot of growth as you're driving around and within our portfolio, and that is the healthcare visits, particularly those that fit more in the kind of retail side of healthcare. Um, I know as growing up, going to the dentist and the pediatrician and ultimately family doctor, you would see a lot more of these in office buildings, typically around the hospitals, where over time they have definitely transitioned into more of a retail type footprint with groups like Dental Works, urgent care centers that ultimately need the foot traffic and the convenience that comes with retail properties. So we love these tenants. Obviously, they're good payers. They have a very stable business, uh, and they help provide that day in day out traffic that helps backfill as we get into sort of the tenanting mix of our centers. But as you see, there are more and more urgent care visits as urgent care helps to supplement and taking loads off of the emergency rooms, and it is continuing to grow in these kind of retail areas with the easy parking, quick drive up access, hop in, go see the dentist, hop in, go see a physician for urgent care, and hop right back into your car. And of course, that's very non-discretionary. When you have medical needs, you need to go see the doctor one way or the other. And then I'm going to jump into banking. So we do have banks in our shopping centers. And while they have been contracting, they are a big use of retail real estate. Um, One reason, and many of you watching are likely going to say, I bank digitally. I deposit my check online through an app. And that is true, but we all need those banking services from time to time. And so when I think of banking centers, it's not just the deposits and withdrawals that you're going to have or talking with a loan officer on site to sign your documents. Um, it also includes those notaries. That's typically the first place you think of when you need a document notarized. But from the bank's perspective, they really look at it not just as a sales volume for that branch, but it's almost a marketing play. If you think about whenever you are ready to change out your banking relationship and moving from one to another, oftentimes you're going to be thinking about, well, which ones are convenient for those random times that I need to see the bank. Um, and so having them, it's a part of their marketing play where you're driving past that Chase Bank day in and day out, and all of a sudden you're looking to change banks, and now you're thinking, oh, that is a place that I can go because it's already on my commute. In this economy, people continue to use banks. So from a tenant perspective, they are very secure tenants that often sign long-term leases and stick around for quite a while. And I will include credit unions with that. Uh, they drive the foot traffic, all the stuff that you're looking for out of a shopping center. And that gets us into how we really utilize um, our our market knowledge to maximize the returns out of our retail centers. And we're thinking about many things. So a big one here with these necessity-based uh, properties is the tenant mix, and it's a lot of how they interact with each other. So as you can see, we have a sample idea of just kind of the day in and day out, because if you've ever been to a busy shopping center in Christmas time, you know that the parking lot is full. If that were true day in and day out every single day, where you just couldn't park your car to visit one of these tenants, you would stop shopping there. So we do need to think about this as we're bringing these in. But you've got things like your morning rush for the coffee shop, the donut shop, the quick in and out type visit on the way to work. Once that dies down, those medical appointments tend to really fill in, and banking tend to fill in some of that daily foot traffic, at least until you get to the lunch hour where you get back to the quick service restaurants. And then same thing on the way home. urgent care, medical type uses in the late afternoon as your kids are off school, if they're the ones going, and then ultimately into the dining hours later into the day, or the post work. I need to grab some type of uses in the for the family on my way home from work with those dollar stores, etc. But it does bring in a much deeper understanding of the retail experience that our leasing professionals, our long-term relationships have really understood to help build a stable shopping center and a tenant roster within that shopping center. So at a high level, what does that mean? As you can see, there's a couple great publicly traded groups. I use them because they have big portfolios with long with lots of data points to tap into. But at a high level, we're seeing increased demand for retail centers as a whole. And that comes from an undersupply since the financial crisis, as well as strong continued tenant demand for space. So if you look at a group like Regency Centers, a publicly traded REIT that has a lot of these necessity-based shopping centers in their portfolio, they have been seeing a decline in vacancy and an increase in occupancy year over year based on their Q2 numbers, because of both the strong demand and the stability of their tenant base. Federal Realty properties, same thing. Not only once you have strong occupancy, but then as you do have tenants renewing, if there's admittedly nowhere else for them to move because you have such limited occupancy or vacancy available in the market, you can start to negotiate those leases come renewal time, assuming there's no options available. But they create a strong data point, and there's other anecdotal ones where a lot of groups are spinning off their necessity-based retail, or if they were grocery anchored shopping centers in the past, they're seeing more value in these necessity-based neighborhood centers. And ultimately, that all comes down to how does it benefit our investors? More occupancy means more income, therefore, presumably better cash flow. Better occupancy means better cash flow, and then better appreciation and sale values when you go to sell the property. When you have the strong tenant bases, you can get better multiples on your cap rate accordingly because you have better credit, and people will price that in. So ultimately it yields better returns for our investors by having a strong tenant base that can survive in good economies and bad. So to kind of reiterate that, it's we're looking at the tenant needs. How frequent do the customers of those tenants come in? And in the retail world, it's all about foot traffic. It is building that portfolio that drives people to your center day in and day out, so that after they stop at the credit union at lunchtime, they're going to hop on over to the sandwich shop and buy a sub before they head back to work. In the evening, when you can tag team those, you're bringing your family out to dinner, but you also need to stop in and grab some more toothpaste at the dollar store or the convenience store there. You really are looking for ways to help not just draw the foot traffic in, but then make it convenient for them as they're coming and going into each store. Specifically in the softer markets, you're really trying to capture those, I'll call mid-tier trade down type tenants, where you're not at the peak, you're not the five-star dining that you only pay for when things are feeling really good. You want to capture them kind of on the top end and bottom end, and there will always be, in good times and bad, those people who don't want to spend $4 for a tube of toothpaste. They'll go to the dollar store and get one for $2. So you can always capture that, but especially as the economy is contracting, having that trade down effect where people can still get all the things they need, but at a cheaper price, helps stabilize those tenants, which helps stabilize their rents, which helps stabilize the returns of their shopping center. And then it's the operational simplicity and really watching what the economy wants and making sure you're setting that up long term to make this a very fluid and easy to manage type investment, whether it's BlackGate owning and running it all for you, or even as you're looking at your own portfolio to tap into that. So at the end of the day, you're always trying to think and be ahead of where the end consumer is. While our clients are our tenants who pay us rent, the consumers have to show up to their stores to make it worthwhile for them to continue paying rent. And at BlackGate, we really focus on those necessity-based retailers because we've seen through good times and bad that they continue to pay rent year over year. And with that, I will conclude the presentation and look forward to any questions that you may have. You can use the Q&A box at the bottom to answer any question or to bring up any questions. I'll give it a minute here to populate. So one question I'm getting is concerned around parking, and particularly if you have too many quick serve restaurants. So restaurants tend to be one of the most heavily parked uses in our shopping centers. So we definitely need to balance the overall parking ratios. Some of this does come down to city requirements, but those tend to be a bare minimum. So as we're under due diligence, when we're buying a center and or as we're looking to bring in a new quick service restaurant, we are definitely conscious of what other uses we have, how many parking spots are available for those uses, and what time of day they are going to be using uh, those parking spots. I'm sorry, to make sure that we keep a good balance in the center throughout the day. The other question I'm getting, or another question I'm getting, is in terms of kind of cap rates and how these types of tenants that we were discussing impact long-term value for our properties. So generally speaking, it's going to be a combination of the use and the credit of that tenant. So a national tenant like a Dollar Tree or a Chipotle tends to bring us a lower cap rate, so therefore a higher valuation relative to, say, a mom and pop tenant or a local convenience store that is a tenant. Um, Ultimately, I'd say the necessity-based retailers do trade at lower cap rates, higher valuations than more of the discretionary type uses, just because most investors understand that they're just a more stable tenant base, kind of long term in both good economies and bad. And at this time, I'm not seeing any other questions, but I will certainly be reaching out to each of you. Feel free to email me if any questions come up, or I'll share my contact information in that follow-up email here, but grateful to have you all attend. Look forward to having you join next month around this time, and we'll be sending out an email with a reminder to talk more about the tax benefits that might apply to you in real estate investing. Look forward to talking again soon.